Fears of an economic slowdown this morning. On Wednesday, two reports sent shivers through Wall Street. The Dow Jones Industrial Average had its worst day since last June, losing 280 points. Stocks fell after a report that just 38,000 private sector jobs were added in May. That's less than a quarter of what analysts expected. The key manufacturing index also fell from its April level. That added to investors' concerns. The rough day on Wall Street came on the heels of bad news from the housing market. A report on Tuesday shows home prices are down more than 5% in the last year, bringing them to their lowest level since 2002. For more on this morning, we're joined by Dr. Peter Morici. He's a professor of economics at University of Maryland. Professor, good morning to you.
Nice to be with you.
Great to see you this morning. Are we in real danger of a second recession?
Absolutely. The economy only grew at 2% in the first quarter, and it appears to continue at that pace. You know, at only 2% growth, most businesses can make all the goods they need and still lay people off because they have productivity improvements that exceed 2%.
But in terms of jobs, Professor, and you look at the numbers that are coming up for the month of May, are we in trouble here? Those numbers look like they're slipping.
Absolutely. You know, we were creating maybe 225,000 jobs a month for the last 3 months. We really need to create maybe 400,000 jobs a month to bring unemployment down to 6% over 3 years. Such a slow pace of jobs creation means that Americans, their wages don't grow, they remain pessimistic about the job market, they don't spend money. The economy can't expand at that pace.
I want to read you something that was written earlier today. Paul Ashworth, Chief U.S. Economics for Capital Economics, says it looks like this recovery has hit its second soft patch, which for a recovery that is less than 2 years old is troubling. Is that a correct assessment to you?
Yes, at this point, the economy should have been growing at 4 or 5% a year, but several key factors have been dragging it down that neither the administration nor the Republicans' policies address. One is the huge trade deficit with China. You know, we send money there, it doesn't come back to buy our products, so it's a drain on demand for American goods and services. The rising price of oil. We're not producing enough domestic energy, and we're importing too much of it. And then there's what nature did to us. The earthquake in Japan, you know, with integrated supply chains around the globe, the third largest manufacturing economy in the world going down the way it did was very disruptive.
We go back to Washington here. A lot of lawmakers there would say you fix the housing crisis. That in turn, or in essence, will also help in the economic recovery. You say that's not the case.
It can't do it. We have millions of unsold homes, homes going into foreclosure and so forth. It's going to take several years to work through that. You know, the best we can hope for is that the market stabilizes, prices don't fall anymore, and maybe begin to rise a bit. But we're not going to have another construction boom. Not until we create jobs, young people can afford to buy homes, and we work off that supply of homes that aren't being used right now.
Let's talk about the debt ceiling, because every expert that we've had on this show says that an agreement will be reached to raise that debt ceiling. If that's not the case, if negotiations go to the 11th hour, do we get to a point where it's too late?
There is a point of no return. If markets start to panic that the United States will not pay interest on its bonds, you know, then it really doesn't matter what they do. Once the market goes negative, once there is this perception the United States is unreliable, then it is unreliable.
Republicans say that they will reach a deal, or a deal could be reached if there are deep spending cuts in the budget. Is that the right way to go?
Government spending is up 25%. It's gone from less than 20% of GDP to more than 26%. That's really too large. However, cutting spending right now when the economy is right on the edge of slipping into recession, not a great idea. Longer term, we really need to spend less money.
All righty. Peter Morici, thank you for your insight this morning, joining us from Washington. We appreciate it.
You're welcome.